Good evening. Please come to AS-2. AS-2 is called Valuation of Inventories. AS-2 is called Valuation of Inventories. A very easy chapter. Some of you might have studied also. In costing also there is a similar chapter called Material. Material, labor, overhead. So we will require your knowledge of cost accounting also. A little bit, not much. And probably you might have studied in foundation course or other courses also. So welcome to AS-2 valuation of inventory. Please let me know what is inventory. Look at the screen, you will get some reasonable idea what is inventory. So you will find there is a warehouse where lot of goods are kept in a different boxes. Then this is also a warehouse and goods are there. This is raw material, timber. Timber can be raw material. It is raw material for furniture. Then you have something going on in the factory. So right now it is WIP, work in progress, semi-finished item. It is neither raw material nor finished goods. This is raw material, and these items which you see in the dispatch section, that is your finished goods. So inventories are basically of three types: raw material, that means totally unprocessed goods which will be converted into finished goods, or WIP, which are semi processed, semi finished goods. Some work has been done, some processing has been done, but it is not yet finished goods. It is not yet ready for sale or consumption. Okay. And then there are finished goods which is ready for sale. So this is some background I have created for inventory. Now I am going to ask you a question. Is this pen which I am using every day, you see also every day, is it inventory? Is this calculator, is it inventory for us? Is this calculator inventory for us? You are not replying. Yes or no? This is my mobile phone. I will not tell you which mobile phone. Okay. This is my mobile phone. Is it inventory for me? Tell me yes or no. No. So pen, calculator, mobile phone, you said these are not inventory. Then what is inventory for me? Is my laptop inventory? I cannot show you my laptop because the wires will get disturbed and lecture can be stopped. So my laptop is also there. Is it inventory? I have a small car, MG Hector. Is it inventory for me? No, no, no. Everybody is saying no. Then what is inventory for me? Okay. This book, this book that we sell to you, is it inventory for me? Yes. One student is saying, I was holding iPhone 13 Pro. Oh my God, I'm not that rich person. Okay. This is old iPhone 6, poor man's iPhone. Hard copy of the book is inventory for me. Pendrive is inventory for me. Google Drive is inventory for me. Very good. So now you have started getting some idea So what is inventory? You have not answered whether my MG Hector car, is it inventory for me? This you have not answered. Mobile phone you have answered. Is my car inventory? The answer is, somebody is saying no, somebody is saying yes. The answer is no. I am an ordinary accounts teacher. It is not inventory for me. But suppose there is a dealer, car dealer. He is also having one MG Hector which is kept for sale. For car dealer, whether this MG Hector is an inventory. For car dealer, whether this MG Hector is an inventory. Right? So you see, sometimes the same item is not inventory for me, whereas the same car, till it was lying with the car dealer, it was inventory. Therefore, one has to really understand whether a particular item is inventory or not. Now this pen, if it is kept in a shop where this pen is sold, for him it will become inventory item. This mobile phone in Apple showroom is an inventory item because it is meant for sale in the ordinary course of business. Therefore, before you decide to apply which standard, you need to know the meaning first. The meaning of inventory is given in AS-2. Inventories are first assets. Assets means they are resource controlled by entity. Assets are resource controlled by entity to enjoy future economic benefit. To enjoy future economic benefit. So first of all, inventories are assets because they will help us enjoy future benefit. Future benefit would be when I will sell it, I will generate revenue. So now you see, inventories are asset held for sale in the ordinary course of business. Held for sale in the ordinary course of business. A teacher is using iPhone and Apple store which is selling iPhone, for whom it is inventory. For teacher it is not inventory. But for iPhone dealer it is inventory. It is meant for sale in the ordinary course of business. Second, it is in the process of production for such sale. Second item of inventory is they themselves may not sell. Like I gave you example of timber. Timber itself may not be sold directly, or let us say coal or other item, but they are used for manufacturing finished goods which are sold. So example here would be raw material which are used for production of finished goods which are to be sold, or WIP, that means some work has been done on the raw material but not yet fully complete. And the third one is in the form of material or supplies, certain materials and supplies to be consumed in the production process or in the rendering of services. So here they have taken some miscellaneous items, like for example, stores items, spares, raw material, consumable. Like in our office, we have a lot of boxes where we package the books. We have envelopes where we put the books and dispatch it to the student. We have tapes. Okay. Fevicol, etc. These will also come under, we have petrol, diesel, because there is a generator set outside. In case if the power failure is there is a load shedding, we can use generator. So we keep petrol, diesel. These are also going to be treated as inventory item because they are going to be consumed in the process of rendering of services also. So all this gets consumed in the process of either production or in rendering of services. So this will also be treated as inventory, right? Next point is inventories includes goods purchased and held for resale. This is for traders. A trader does not manufacture or produce goods. He buys and he sells. Okay, he buys and he sells. For him, such items are also inventory that is meant for resale. That is meant for resale. So today you go around the market, you will find in the market there is a clothes store, there is a mobile store, there is a electronic goods store. All of these companies, they purchase from the manufacturer or the dealers and they sell to the retailers or consumers or customers. What are those items which they are keeping in their shop or warehouse or showroom called? They are called inventory. They are called inventory. Inventory also include intangible goods such as software. For example, you want to purchase accounting software, for example, Tally. You go to a dealer or a vendor of Tally, you pay him the amount and he sells you the software or gives you the license to operate that software. So nowadays these softwares are also inventory item. If you want to purchase our video lecture on Google Drive, that is also inventory. That is also inventory. But inventories do not include machinery spares. Inventories do not include machinery spares which can be used only in connection with an item of fixed asset and whose use is expected to be irregular. So this is a small exception, keep in mind. This is a machine and this is a spare part. If this spare part can be used only for machine A, only for a specific machine, and second, the use is irregular. Use is irregular. It is not regularly required. Only when in exceptional case when the machine breaks down or there is a problem, then this spare part is used. Then such spare part will not be called inventory. Then what they will be called? They will be called property, plant and equipment. They will be called property, plant and equipment. Our institute had issued one amendment on this point, which is printed in your notes also. I hope everybody has got books in front of them. Inventories do not include spare parts, servicing equipment, and standby equipment, which meets the definition of PPE as per AS-10. Such items are accounted in accordance with AS-10. So, what is the treatment of spare parts or any standby equipment, extra asset? Standby equipment means suppose you have a car, so you'll find there is a stepney also you have. That is standby. I have two computers in my classroom. If one does not work, I will start using the other. So that is why it is called standby. If they meet the definition of PPE, we will see in the next few days AS-10 coming soon. property, plant, equipment. If they meet the definition of PPE, then apply AS-10. If they do not meet the definition of PPE, then you will apply AS-2. That is the small amendment. Next point is importance of inventory valuation. How is inventory figure brought in the books of account? How inventory figures comes in the books of account? Closing inventory. You see one interesting thing which you already know, that all figures are available from the books of account at the end of the year. But one figure is not available from books of account. Which is that figure? That figure is closing stock value. That has to be first calculated. That has to be first calculated and then recorded in the books of account. Then recorded in the books of account. So therefore this figure comes from outside the books of account. And in case if you don't value the inventory properly, profit and loss account will be affected. Net profit will be affected. In balance sheet, stock figure will be affected. In balance sheet, current ratio figure will be affected. Then in balance sheet, the whole net worth will be affected. So by making a mistake in inventory valuation, your gross profit, net profit, stock figure, current asset figure, current ratio, okay, your capital employed, that is your net worth, financial position can change. Wrong valuation of inventory can result into a wrong presentation of profitability and a wrong presentation of financial position. Therefore, inventory needs to be carefully valued as per AS-2. Inventory constitute a significant proportion of the total asset. Take any balance sheet of any company. You will find that on the asset side, there is inventory. And today you will try as homework, take balance sheet of any company, you can get it on internet. Total of the asset side is suppose 1000 crore. Out of that, inventory itself may be 250 crore or 300 crore or 500 crore depending upon kind of business, which means a significant proportion of the total asset is devoted to inventory. Second thing, inventories are susceptible to spoilage and obsolescence. Inventory requires care. Inventory require care. Inventory require attention. If you don't pay proper attention to inventory, it will be spoiled. That means depending upon inventory, some inventories have a limited life like milk, vegetable, fruits, okay, grains. So if you don't store properly, it can be spoiled. It can become obsolete also, outdated. If you are a book vendor and if you have kept stock of direct tax books and if you don't sell before the close of the year, assessment year will change. Books will become outdated. Therefore, they need care and management. Inventories are kept at different places also. So, at the end of the year, you have to ensure that inventories kept in factory, warehouse, with agent, with customer, which is your inventory, is included in the financial statement. Proper inventory valuation will affect financial performance and financial position. I have told you. See one more time. Suppose this is my trading and P&L account item. I will write here buy closing stock. These closing stocks affect my gross profit. Gross profit will affect my net profit. So if you put this value more, your GP will be more. If you put this value less, your GP would be less, net profit would be less. So you can affect your financial performance and financial position by valuation of inventory. Inventory requires some degree of estimation also. For example, when we do valuation of work in progress, it will require estimation of what is the stage of completion, how much percentage the work has been done. Sometimes we have to make estimation in calculation of net realizable value, NRV. Sometimes we have to estimate NRV. So some degree of estimation is also involved. First few paragraph was just basic introductory paragraph. My real accounting standard begins now. What is the objective of AS-2? The objective of AS-2 is to help you in determination of the value of inventory. Is to help you in determination of the value of inventory which are carried in the financial statement until the related revenues are recognized. Okay, so basically the objective is to arrive at true value of inventory. Inventories are carried in balance sheet till sold. Inventories are those items which are carried in balance sheet till sold. So this standard tells you at what value the inventory should appear in the balance sheet. Second is it helps you to determine the cost of the inventory, that is how to calculate cost. In the next few minutes we will see how to arrive at the cost of inventory, and then the standard will also guide you when the value of inventory should be written down below the cost. So there is a guidance in this standard. It says inventory should be valued at cost or NRV, whichever is lower. So if NRV goes down, we need to reduce the value of the inventory. Now just for a quick understanding, our standard always gives you applicability, means where is the standard applicable or where it is not applicable, where it is applicable or where it is not applicable. Okay, so this standard is not applicable in following cases, not applicable in following cases, which means other than these few items mentioned here, the standard is applicable. First is WIP, work in progress, arising under construction contract, arising under construction contract, including directly related service contract. They will be covered by AS-7, so not in the current chapter, but in AS-7. Second, this standard does not deal with work in progress arising in ordinary course of business for service provider. This standard does not deal with WIP in the ordinary course of business of service provider. So if somebody is providing audit service and audit service is not yet complete, then this standard is not applicable. Other standard will be applicable, but not this standard. Okay, this standard does not deal with service providers. Those who only provide service, they may not have completed their work by the end of the year. So AS-9 will apply, or maybe AS-7 will apply, but AS-2 does not deal with service providers. Third is, this standard does not deal with financial instrument. Example of financial instrument: share, debenture, bond. Shares, debenture or bond held as stock in trade. So even though they are held as stock in trade means for day to day trading purpose. For day to day trading purpose, this standard is not applicable. You can't apply AS-2 for the dealers who deal in shares, who deal in bonds, who deal in debenture. This standard is not applicable. Then this standard is not applicable for producer, those who produce, those who produce. The standard does not deal with producers' inventories like livestock, agricultural and forest products and mineral oil. So suppose you have a forest on which you have tree has mango, standard is not applicable. Or suppose you have a farm, you are growing wheat, you are a producer of wheat, standard is not applicable. But suppose you are a trader, not producer, you buy wheat and sell wheat, standard is applicable. Standard is applicable if you are trading in mango, if you are trading in wheat, if you are buying and selling horses, if you are buying and selling dogs, standard is applicable. But if you are a producer, then the standard is not applicable. The reason is it is very difficult to ascertain their cost. Difficult to ascertain the cost. How will you ascertain the cost of your own wheat which you have grown? But in Ind AS, for your general knowledge, in Ind AS, what is Ind AS? Indian accounting standard applicable to big companies. There is a standard called Ind AS 41 agriculture. In that standard, they have dealt with this item also, that is producers inventory of livestock, forest product, etc. Now we'll come to one important definition. Definition of NRV. NRV. What is NRV? Net realizable value. This standard says take cost, take NRV. Okay. Whichever is lower will appear in balance sheet. If NRV is lower than cost, take NRV in the balance sheet. If cost is lower than NRV, take NRV in the cost in the balance sheet. So I need to tell you what is the meaning of NRV, and you will also be interested in knowing why they are saying take lower of the two. The answer is simple. This is prudence concept. This is prudence concept. If cost is lower than NRV, we will take cost. So do not recognize anticipated profit. In the first case, this is case 1, when cost is below NRV, we take cost, do not recognize anticipated profit. But this is case 2, when NRV falls below the cost, we recognize inventory at NRV, anticipated loss can be provided. Concept of prudence. If NRV has gone down, I know that this inventory will be sold below the cost. I can foresee the loss. There is going to be loss. Why wait? Why not provide for it? Okay. But how to calculate NRV? NRV means estimated selling price in the ordinary course of business, normal course of business. not under coercion or undue influence or threat. Ordinary course. Buyer is free to buy from anyone, seller is free to sell to anyone. Buyer has a choice, seller has a choice. That market is ordinary course. If I put a gun on your head, gun, this is gun, okay, and I say you have to buy at this price or you have to sell at this price, that is not ordinary course. Okay, I hope you liked that idea. Minus, reverse working you have to do. You are standing here, this is seller, this is customer, okay. He will sell to the customer at 100 rupees. That is your estimated selling price. However, in order to make the sale, he will have to incur certain cost. In order to complete the sale, the seller will have to incur certain cost. What are the cost he will have to incur? He will have to incur transport cost. Okay, loading and unloading. Customers nowadays are very demanding. He will need door delivery. So 10 rupees I will incur on transportation only. 2 rupees on loading on the tempo. Another 2 rupees on unloading from the tempo. So customer will give me 100. But what finally I get? 100 minus 10 minus 2 minus 2. So I receive 86 rupees. 86 rupees comes to my pocket. 86 rupees comes to my pocket. Therefore, 86 will become net realizable value. If I sell this inventory item to a customer, how much net amount I will realize after incurring cost which are required to complete the sale. After incurring the cost which are required to complete an estimated cost necessary to make the sale. So if I have some inventory item in my godown and if I have to calculate NRV, I will do reverse working. At what amount I can sell in the ordinary course? 100. What are the other costs I may have to incur? 14. So NRV is 100 minus 14, 86 rupees. Because finally what I will get when I will complete the sale in my pocket is not 100 rupees but only 86 rupees. So standard is very conservative and it says you deduct any cost that you will need to incur to complete the sale or any other selling expense will be deducted, right? So today, along with the concept, we are simultaneously going to take question also. So you will not get bored. Related question given in our book also we will cover with the concept. So the concept you have learnt is NRV, which is estimated selling price minus cost to complete the sale. Minus cost to complete the sale. And you have also learned inventory will be valued at lower of the cost and NRV. So let us apply these two things in our given question. Are you ready? Only on the screen. Look at the question on the screen and answer. Do not copy from the book. You will find this question in your book somewhere. Do not worry. When I will tell you, that time you will write the answer or write the question. Otherwise, all question and answer are printed in the book. You have to concentrate on learning. Okay, you are a grown-up student. It is unfair to make you write throughout the day. More time we will spend on discussion, learning. Are you ready? Yes. Ganesh ji, pranam. An enterprise has in its stock 10,000 bags of cement purchased at a cost of 180. So on one hand we have cost 180 and I have to also get NRV. Let us read further. The terms of the trade are such that cement is delivered at the buyer's door and the cost of delivery to dispatch the goods we will require rupees 10 is paid by the seller only. The selling price, estimated selling price is 187 per bag. Find the value of the closing stock. First chance to the student. Please reply. First chance will be given to the student to reply. What is the value of the closing stock? Estimated selling price is 187. Transport cost is 10 rupees. Cost is 180 and 10,000 bags are lying in the closing stock. So I would ask you to answer. Please reply. Please reply fast. Can you reply? So the inventory will be valued at cost 180, NRV 187 minus 10 rupees required to complete the sale, 177. So lower of the two is 177. So all inventory will be valued at 177. Quantity is 10,000 bag. So valuation will be 177 into 10,000. So this is 17 lakh 70,000. 17 lakh 70,000 is the value of the inventory. Arjun, Sanket, Pavan, Sakshi, Falak, Ganesh, Moonrise, Chaurasia, Sonam, Kirti, Saurav, Tanya. Amazing. You people are really genuinely intelligent. Okay. So this is the answer. Cost 180, NRV 177 and valuation is 17 lakh 70,000. Any query on this question? Okay, one more practice we will do. This question is from April 2021 MTP 5 marks. You will only concentrate on the screen and answer. Okay. X company limited purchased at a cost of rupees 40 lakh in October 2020 till March 2021. 75% of the stock was sold. 75% stock is sold means 25% is remaining. 25% is remaining means the cost of inventory or the cost of closing stock in hand is 40 lakh into 25% and that is 10 lakh. So all of you will agree the cost of inventory in hand is 10 lakh. Company wants to disclose the closing stock at 10 lakh. This is company's view, not my view. Company's view is 10 lakh. Why 10 lakh? 25% of 40 lakh. Expected sale value, this is expected sale value 11 lakh. To calculate NRV, I have to take 11 lakh minus a commission of 10% on sale. You have to incur brokerage of 10%, which means NRV will be 9.90 lakh. NRV will be 9.90 lakh. Advise what is the correct closing stock to be disclosed on 31st March 2021. 5 mark question. It is a bonus mark. Okay. 10 lakh is the cost. 9.90 lakh is the NRV. So the answer is Lower of the two, 9.90 lakh is the value of the stock. Is it right? Say yes. So 9.90 lakh. So your answer would be something like this. All answers are printed. When I will tell you, that time you will write. Keep the printout, the book in front of you. You will answer like this: as per AS-2, inventories are to be valued at lower of cost or NRV. First, you have to write the provision of the AS-2. Provision of AS-2. What AS-2 has to say. Then start calculation. First, calculate the cost of inventory. 25% into 40 lakh, 10 lakh. Then calculate the NRV, okay, which is 9.9 lakh, and then write the conclusion that inventory will be valued at 9.9 lakh. Tiwari is right. Tanya is right. Come back to your notes. Now, valuation of inventory will start. What is the golden rule of this chapter? Golden rule. Inventory should be valued at lower of the two, cost of inventory or NRV. And the logic is prudence. The logic is prudence. Note, there are few exceptions. There are few exceptions that we will discuss later. There are some exceptions where inventory is valued at cost only or at NRV only, not at lower of the two. So there are few exceptions. We will see. The exception is that certain inventories will be valued only at cost and certain inventories are valued only at NRV. But otherwise, in general, inventories are valued at lower of the cost or NRV. So my focus should be for next few minutes how to calculate the cost. How to calculate the cost of inventory. If you have studied cost accounting subject, so please raise hand. Answer. How many of you have studied cost accounting subject? Because after this, some knowledge of cost accounting subject would be added advantage, but not a necessary condition. I am going to explain everything. But if you have studied cost accounting, it will help you. So in costing also we learn the same. Your teacher prepares a cost sheet for you where you write direct material, direct labor, direct expense, overhead, etc. So we are also going to do similar thing. So cost of inventory would include, suppose you are manufacturing something, you are producing or manufacturing something, then in that case you will take cost of purchase, cost of basically whatever raw material, components, etc. required. So you purchase raw material and components and you have to convert into finished goods. And you have to convert into finished goods. Is it right? The cost that you will incur to convert raw material into finished goods, they are called conversion cost. So conversion cost would be, example, labor, direct expense, and in this chapter, production overhead. Production overhead, also called works overhead or also called factory overhead. So our AS-2 only allows you to add production overhead. Administration overhead are not allowed. However, if administration overheads are directly attributable, directly attributable to bring the inventory to its present location and condition, then only such administrative overhead can be added to the cost of inventory. Okay, but otherwise not. And any other cost, first is cost of conversion, any other cost which are incurred in bringing the inventory to their present location and condition, they will also be added. For example, machine hire charges, design fees, these are some other costs that can also be added. Now we'll study in detail. After this, we'll study in detail which cost should be included in the cost of inventory and which cost will not be included in the cost of inventory. Right? So, cost of inventory does not include. This was a question also in one of the exam, right? Important. If you have book in front of you, you will say cost of inventory does not include. What is not included? Abnormal amount of wasted material, abnormal amount of wasted material, labor or production cost. Abnormal item is not included. Why? We do not want to, we do not want to increase the value of inventory due to abnormal items, due to abnormal items. We do not want to increase the value of inventory due to abnormal items. So such abnormal expenses will be charged to P&L account. Such abnormal expenses will be charged to P&L account. So abnormal wastage of material, abnormal labor cost or any such abnormal production cost will be charged to P&L account. Then we do not include storage cost. We do not include storage cost. However, there is an exception. Right here, what is the exception? The exception here is if storage is necessary, storage necessary for production. If storage necessary for production, if storage is necessary, it is a part of the production process. Like for example, say wine. Although example is not good, should not be given in front of young minds, but I can't help it. Wine, once the basic processing is done, basic processing is done, then wine is stored. And wines are stored for many years, for 5 years, 10 years, 40 years, so that the taste will improve, the value will improve, and it will fetch more price. In that case, even the storage cost will be added to the cost of wine. Have you understood? So, storage cost, there is an exception. What about administrative overhead? Normally not included, but here also we have exception. Exception is if incurred to bring the inventory to bring the inventory to its desired location and condition. To bring the inventory to its desired location and condition. For example, travel expense of purchase manager to purchase inventory. Travel expense of a purchase manager to purchase inventory. It is an administrative expense, but it is incurred to bring the inventory to its present location and condition. Then that will be also included in the cost of inventory. And selling and distribution cost never included. Selling and distribution cost is never included. Never. Abnormal wastage never. So these two, 1 and 4, never. 2 and 3 have exceptions. Cost of purchase. Cost of purchase. When you purchase the inventory, have you ever seen any invoice? Look into the invoice carefully. They will write there purchase price, basic amount. Nowadays they will add GST, freight inward. Somewhere below they will write also transportation charge, delivery charge, loading charge, unloading charge. Those also you will add, and any other expenditure which is directly attributable to the acquisition will also be added. Example, inspection cost. Now in case of GST, asterisk mark. Why? Because as per the law, if you pay GST on input, then you will get credit, input tax credit, ITC, when you have to pay the GST on final output. If you are going to recover, link these two things. If you are going to recover GST from the government at the time of final payment, then do not include such duty, taxes, etc. for which you will get credit and which can be set off against future tax liability, or which you will get as refund. Such duties, taxes which you will either get refund or which you will be able to set off against future taxes payable will not be included. So if you have purchased raw material, GST paid 18, but on this GST 18, input tax credit 18 is available, so I will not include it. My cost of raw material will be only 100 rupees. But suppose you don't get that ITC on input purchased, then my cost of inventory will become 118 rupees. What will you do as a student? Assume, if it is GST, assume input tax credit is available and write a note. If GST is given in the problem, assume that input tax credit is available, write a note, and do not include in the cost of inventory, then input tax credit will appear as a separate asset in the balance sheet. The ITC appears as a separate asset in balance sheet. Okay. Then you will not include any trade discount or rebate. You will not include duty drawback. Duty drawback means duty paid is refunded by government. So if you are going to get the refund of the duty paid, do not include in the cost of inventory. or any such similar items. So institute will give you a question which will have 10 items. Purchase price 1000, duties 50, freight inward 5, other expenditure 10, duties recoverable from taxing authority 25, trade discount received 10, rebate 0, drawback 0, this is 0. And now they may ask you, find out the cost of the uh, inventory. So I will take 1000, I will plus 550 plus 5 plus 10 minus 25 minus 10. This will help us to calculate the cost of inventory. So this is called calculation of purchase price first. Then the next important task is conversion cost. If you are a manufacturer, producer, then in that case, this raw material needs to be converted into finished goods. So to convert that, you will require direct labor, direct expense, and production overhead. So these three together, we will call it as conversion cost. This we will call it as conversion cost, right? So conversion cost are such costs which are required to convert the raw material into finished goods. Include costs which are directly related to the unit of production. So what is included? DL, DE and production overhead. About administrative overhead, I have told you. Administrative overhead will only be incurred if they are incurred to bring the inventory to its present location and condition. But other cost will be included. So without wasting much time, because you are champion, what is direct labor? Question before the student is, what is direct labor? What is direct labor? Is Mukesh Ambani a direct labor in Reliance Industries Limited? Mukesh Ambani is a direct labor? No. Is Virat Kohli a direct labor in that Indian team? Tell me, what is direct labor? So direct labor means those labor cost. Labor cost means human cost. Cost related to human beings. Okay. Who are direct, whose cost is directly attributable to the unit of production completed or in the course of completion. That means, suppose there is a factory worker. One student gave this example and he is paid 20 rupees per hour. So his wages or his salary can be directly attributed to the output that is produced in the factory. If there are 100 outputs produced and he is paid 2000 rupees salary, I will say these 2000 rupees were incurred for this 100 unit. If that can be done, then we will say he is a direct laborer and the cost is a direct labor cost. So normally people working on in factory, shop floor, okay, where there is a direct one-to-one relationship between the cost incurred and the output generated, then those labor cost can be treated as direct labor cost. Mukesh Ambani is sitting in his cabin. We cannot identify how much output he has produced. Therefore, salary of Mukesh Ambani is not direct labor cost. Okay, but salary of people working in the factory, Reliance Jamnagar factory, That is a direct labor cost. And what about direct expense? Same idea. Those expenses other than material and labor which are directly attributable to the production, then such expenses will be called direct expense. For example, you hired a machine and this machine was hired to do production of 100 units. Now this hiring charges paid is neither direct material nor direct labor. You paid 2000 rupees for hiring the machine. 2000 rupees can be directly attributable to 100 units produced, or you got the finished goods design, you paid design charges. 1000 rupees design charges was paid, 10 units of finished goods was produced. This is direct cost. Okay. Molds and pattern, correct. Molds and patterns, direct cost, which are manufactured or purchased or designed required for your business purpose. So as far as three items are concerned, we don't have much problem. Direct material, direct labor, direct expense. Together they are called prime cost, and usually they are variable. Usually they are variable direct cost. Because more you produce, more material, more labor, more direct expense you will incur. Our AS-2 also requires that you must also add direct material, direct labor, direct expense, that is prime cost. You will also add production overhead to arrive at the cost of inventory. So this standard allows you to add production overhead to arrive at the cost of inventory. Now my question is, what do you mean by overheads? What do you mean by overheads? Overheads means indirect costs. Overheads means indirect cost. Now what do you mean by indirect cost? Cannot be cannot be directly cannot be directly attributed to units of production. I don't know which expenditure was incurred for how many units. They were incurred, but I can't prove a nexus between the expense and the output. Like the rent of the factory is paid for the whole year. Okay, factory supervisor salary is paid, power bill is paid, depreciation of factory building, factory machine is incurred, but we cannot prove a nexus between the overhead incurred and the output produced. Therefore, they are called overheads. And if it is related to production activity, then they are called production overhead. If it is related to administration, it is called administration overhead. If it is related to selling and distribution, it is called selling and distribution overhead. This standard says forget administration overhead and selling and distribution overhead. Already you have seen in the exclusion list. What you have to only consider is production overhead as per AS-2. Further, the standard says divide your overhead into two categories. Divide your production overhead into two categories. Which two categories? Variable and fixed. Variable and fixed. As the name suggests, variable production overhead will vary directly with the volume of production. Vary with the volume of production. More production, more variable overhead. Less production, less variable overhead. Do you have any example of variable production overhead? Variable production overhead. Give me the example. Give me the example of variable production overhead. So the answer is uh, power. Some portion of electricity may be fixed, the fixed charges, but some portion is variable. As you produce more, more electricity is consumed. Okay, therefore, power can be example of variable production overhead. Then there are fixed production overhead. Example, rent of factory, salary of factory workers, salary of factory workers, they are fixed. Insurance of factory, insurance of factory, that is fixed. One more variable example one student has given is fuel. Yes, it can be variable overhead. So most of you are giving rent example for fixed overhead. Very good, rent. Everybody is saying rent only. I gave you another example, salary of factory supervisor, factory worker, insurance, depreciation. Okay, factory property tax, fixed power bill, fixed power bill, fixed telephone bill. Okay, depreciation. So these are all uh, example of fixed overhead. What about the treatment? First meaning, fixed overhead are such indirect cost which remain constant regardless of the volume of production. Regardless of the volume of production. So once you have taken factory on rent 1 lakh rupees per month, whether you produce 1 unit or whether you produce 1,000 unit, you are going to pay a fixed rent of 1 lakh rupees per annum per month. So you are right. Now the question is how to allocate fixed and variable overhead. First we will discuss about allocation of variable overhead. Variable overhead varies with the output. More output, more variable overhead. Less output, less variable overhead. So the standard is also very simple here. Variable production overheads are assigned to each unit on the basis of actual use of the production facility. So underline the word actual use. Variable overheads are assigned based on actual use of the production facility. So what you do, you write one formula, variable overhead per unit is equal to variable overhead divided by actual output, divide by actual output, divide by actual output. For example, in a year variable overhead incurred is 10 lakh and actual output was 1 lakh. So this will give you 10 rupees per unit of variable overhead. This will give you 10 rupees per unit. And suppose in the closing stock, you have 20,000 units in the closing stock. So the variable overhead you are going to allot to the closing stock will be 2 lakh. So you will say out of 10 lakh, 2 lakh rupees of variable overheads relate to closing stock. That is how variable overheads are allocated. So first step, compute variable overhead per unit. Total variable overhead divided by actual output, actual production, actual capacity, actual. And then you see how many units are in the closing stock. 20,000 into variable overhead rate per unit. So 2 lakh rupees will be allocated to closing stock. So that is amount of allocation. Variable overhead per unit into actual production. We'll take one example on this a little later. Just first complete fixed overhead part also. Allocation of fixed overhead. Now fixed overhead has a small problem. It remains fixed. It remains fixed irrespective of the output. So here the standard has, for fixed overhead, they have given 3 situations. According to the situation, you will apply the formula. So situation can be your actual capacity is equal to normal capacity. Normal means what is normally utilized. Second possibility is your actual capacity utilized is less than normal capacity. Like it happened in the lockdown period, your actual capacity was much lower than the normal capacity. And third possibility, actual capacity is more than normal capacity. In peak year, there was some extraordinary demand. Okay, so companies can operate above the normal capacity only. So for 3 situations, which we'll call case 1, case 2, case 3, see the treatment. First, we will see the note is in front of you. The allocation of fixed overhead for the purpose of inclusion in cost of conversion is based on normal capacity. Basic principle is fixed overhead should be allocated based on normal capacity. Now the student is asking me, what is normal capacity? Somewhere below in your notes you will find it is written, what is normal capacity? Normal capacity is the production expected to be achieved on an average over a number of periods or seasons under normal circumstances. Normal capacity means, suppose if you look at the last few years of data, year 1, 2, 3, 4, a company finds that on an average it is able to produce on an average 80,000 unit. In the long run, the company finds that it is able to use 80% of the capacity. Full capacity is 1 lakh. This is full. Normal capacity is not necessarily full capacity. Normal is what you normally utilize. What you normally utilize. A businessman knows with experience what is the normal capacity that he can utilize. If he is a new businessman, he can take the help of other firms in the industry and he can check what is the normal capacity utilization in his industry. Okay, so if you are a car manufacturer company, Maruti, you know you can produce 2 lakhs car in a year. That is your maximum or full capacity. But last 5-6 years of data suggests that you are able to utilize 80% or 90% only. Even the other players in the car industry segment, Hyundai or Mercedes or BMW, they are also able to utilize 80-90% capacity. So that will be taken as normal capacity. Okay. The actual level of production may be used if it is approximate to normal capacity. If actual and normal are same, then it does not matter only. One can use actual capacity also if both are same. Now very important, coming soon is allocation of fixed overhead. The formula for allocation of fixed overhead is per unit calculation will be fixed production overhead divided by normal capacity. Divided by normal capacity. This is normal formula. But there is an exception which I am going to tell you in a minute. So normally for fixed overhead, they are saying take normal capacity so that you will get normal cost per unit. So that you will get normal cost, usual cost per unit. Okay. And actual production into allocation per unit will give you amount to be included in the closing stock. Actual production can be more than or less than normal capacity. Now, three situation I have told you. Situation number one is actual production and normal capacity are same. This is very easy for the student at least. Normal capacity was 80,000 unit. Actual is also 80,000 unit. So there is no problem. What I will do, I will take the total production overhead divide by normal capacity or actual capacity. It does not matter because actual and normal are same. In your book you will find there is one example printed with 3 columns. Case 1, case 2, case 3 is written. Now you have to write. In the first case 1 column, now I am going to tell you how fixed overheads will be included in closing inventory. So come on student, write down in only the first column, case 1 column, normal capacity, write 2 lakh units, fixed overhead rupees 8 lakh, actual production is also 2 lakh unit. Can you see? Normal and actual are same. So what will happen now? My overhead is 8 lakh. Divide by 2 lakh. I will get rupees 4 as fixed overhead per unit. 4. Actual sale is 1,60,000. 2 lakh unit you have produced. 2 lakh units you have produced. 1,60,000 you have sold. So how many units are there in the closing stock? 2 lakh production minus 1,60,000, 40,000 is the closing stock. Now my question to you is, how much production overhead will be included in cost of sale and how much production overhead will be included in closing stock? Your chance to answer now. Your chance to answer those two queries. I am waiting for your answer. How much production overhead will be included in cost of sale and how much production overhead will be included in closing inventory? Come on, reply. So I will tell you now. Some of you have started answering also, that's good. 1,60,000 into 4 1,60,000 into 4 will be included in cost of sale, and 40,000 unit into 4, 40,000 into 4, that is 1,60,000. 1,60,000 will be included in the closing stock. 40,000 unit into 4 rupees per unit. This was very easy because there was no complication involved. Actual and normal are same. Come to case 2. And what is case 2? Case 2 is dangerous. Actual production is less than the normal capacity. Actual production is less than the normal capacity. Actual production is less than normal capacity. Now the standard says if actual is less than normal, allocation will be based on normal capacity only. Allocation will be based on normal capacity only. Why? Let us see. Normally your study modules don't give you the proper reasoning. Okay. So first I will tell you why. For that I need to write some example. Calculation based on actual and calculation based on normal. Fixed overhead. Fixed overhead incurred is 10 lakh. Capacity. Suppose my actual capacity utilized is 10,000 units, but my normal capacity, let us say, is 1 lakh unit. Normal capacity is 1 lakh unit. So what will be overhead rate per unit if I apply actual capacity for calculation 10 lakh divided by 10,000, you will say overhead rate is 100 rupees per unit. But if I apply normal, you will say overhead rate is 10 rupees per unit. Now, if I take 100 rupees, suppose I am doing inventory valuation. Suppose I am doing inventory valuation, I will write material, labor, direct expense, variable, overhead, all put together 100 rupees, and then I will say add fixed overhead. If I am using actual capacity for calculation, I will add 100, and if I am using normal capacity, I will add 10. So using actual, my cost of inventory will become 200 rupees, 100 rupees material, labor, direct expense and other variable overhead, and fixed overhead 100 rupees. In second case 110 rupees. Now there is a problem in this. You have unnecessarily increased the value of your inventory. You have unnecessarily increased the value of your inventory. Your normal capacity is 1 lakh. You have actually utilized only 10,000. So you are inefficient. You are inefficient. You means the company, not the student. You are inefficient. You have a capacity of 1 lakh unit and you are only producing 10,000 unit. So are you not inefficient? If the answer is yes, then your inefficiency should not be included in inventory cost. Your inefficiency should be charged to P&L account. Your inefficiency should be charged to P&L account. If you are inefficient, you should bear the loss. You should not include in inventory, because if you put that in inventory, it will get transferred to next year. So the standard says, because you cannot even use the normal capacity, you are inefficient, and because of your inefficiency, inventory value should not increase, rather your P&L account should be charged, and value the inventory using normal capacity. Because there may be some other firms in the industry, the other firm is using full normal capacity, their inventory will appear at 110 rupees and your inventory will appear at 200 rupees. That is wrong. So therefore take normal capacity. So inventory value does not become too high. So inventory value does not become too high. So that is the logic. If somebody asks you when you'll go for articleship in an interview, why do we take normal capacity when actual capacity is below? The answer is inventory value should not become too high. Inventory value should not become too high. I have shown you with the numbers, 200 rupees versus 110. So take normal only. Okay. But if you use normal capacity instead of actual capacity, when normal capacity is more, some overhead will remain unabsorbed. Some overhead will remain unabsorbed means they will neither be included in cost of sale nor they will be included in inventory cost. In that case, that unallocated or unabsorbed overhead will be charged to P&L account as an expense in the period in which they are incurred. Unallocated overhead will be charged to P&L account in the year in which they occur. Now you will say, sir, give me some example. That is why in your book, dear student, we have prepared one case 2. Kindly come to case 2. Case 2 column is blank for you to finish it. Come on, right there in case 2, middle column, normal capacity, right? Normal capacity, write down 2 lakh unit. Normal capacity 2 lakh unit. Fixed overhead, write down fixed overhead 8 lakh rupees. Fixed overhead 8 lakh rupees. Then actual production, write down 1 lakh 60,000. Actual production, write down 1 lakh 60,000. Now the institute is going to ask you a question. What will be allocation per unit? So I will take 8 lakh divide by normal capacity. Divide by normal capacity. That is 2 lakh. So my answer is 4 rupees. I don't want it to increase. I don't want my overhead rate per unit to increase, because if overhead rate per unit will increase, then my cost will also go up. Then my cost will also go up. Now write down actual sale is 1,50,000. Student will take effort and replying now. If production is 160 and sale is 150, what would be my inventory in this column? Please reply. Production 160, sold 150, so my inventory would be 10,000. Now next question for you. How much amount will be included in cost of sale? 1,50,000 into 4. How much amount will be included in cost of sale? So the answer would be 6 lakh. The answer would be 6 lakh. If you want to write 1,50,000 into 4. Next question for you. How much amount will be included in inventory? This is 10,000. This is 4. So how much fixed overhead will be included in cost of inventory? 40,000. 10,000 into 4. 10,000 into 4. Now you see one problem. The total of these two is coming to 6,40,000. Is coming to 6,40,000. Oh my God. But my actual overhead is 8 lakh. My actual overhead is 8 lakh. So there is going to be a problem now. Okay, there is going to be a problem. You have incurred 8 lakh. You have only included 640. So what will happen to the remaining overhead? What will happen to the remaining overhead? Come on. What will happen to the remaining overhead? The remaining overhead will be underabsorbed, unabsorbed, unallocated. And the standard says if it is unallocated, you will charge it to P&L account as an expense, and that is called under absorption. 1,60,000. 8 lakh minus 6 lakh and minus 40,000 will remain under absorbed. Or you can also calculate it as follows. Total capacity is for 2 lakh, but production is only 160. So 40,000 units not produced into 4, that is also 1,60,000. That is also 1,60,000. Okay, hopefully now you have understood. That is the beauty of AS-2. It says you don't over absorb, but there may be under absorption. Third possibility is your actual production is more than normal capacity. Now here there is an exception. And what is the exception? In this case, the overhead will be absorbed on the basis of actual capacity. The overhead will be absorbed on the basis of actual capacity. It's written in your book. Overhead will be absorbed on the basis of actual capacity. If your actual production is more than normal, then the rule is it will be based on actual capacity. Now you will ask me why? Why? Okay, like Hindi serial, why? So I'm going to tell you now why we will take actual and why we will not take normal. First, you understand, suppose my fixed overhead is 10 lakh. My fixed overhead is 10 lakh. And my capacity in units, this year it was good. Capacity utilized 1 lakh. And normal capacity is, for example sake, 20,000. And you utilize 5 times more. Whether I take 20 or 30, it is okay. Concept you can understand. So now my overhead rate per unit will be A by B. Here it will be 10 rupees. Here it will be 50 rupees. Now you see the problem. If I am doing valuation of inventory, For assume all units are in closing stock. All units are in closing stock. Assume only. What is the harm in assumption? Entire 1 lakh units are in closing stock. I produce 1 lakh unit, but there is lockdown, nothing was sold. So my closing stock is equal to 1 lakh unit. How much fixed overhead I will absorb? How much fixed overhead will be included in closing stock? How much fixed overhead will be included in closing stock? You will simply say number of units into rate. Suppose you applied 50 by mistake, normal. See the problem. You will include 50 lakh rupees in the closing stock. You will include 50 lakh rupees in the closing stock, but your actual expenditure incurred is only 10 lakh. Your actual expenditure incurred is only 10 lakh. Such an interesting thing. Suppose this is my trading and P&L account. I incurred 10 lakh on the debit side and my closing stock is 50 lakh. Don't you find it very funny? You incurred 10 lakh, you actually incurred 10 lakh, and you are saying my closing stock is 50 lakh. That is called over absorption. That is called over absorption. I can't allow you over absorption. I can't allow you to include in inventory more than what you have actually incurred. Oh, that is the reason. That is the reason why we say that when actual production is more than normal, take actual capacity. So the logic is there should not be over absorption. You can write it. There should not be over absorption. That is, you can't absorb. You can't absorb more than what you have actually incurred. You can't absorb more than what you have actually incurred. I have shown you. Now this logic they will not give you in the study module. You have to understand them. Okay? I hope I have made myself clear. If, remember, if actual and normal are same, you can take normal. If actual is less than normal, then also take normal capacity. But if actual is more than normal, then we have to take actual capacity. Then we have to take actual capacity. Okay, have you noted? So can I write one golden line, golden rule? Actual or normal capacity, actual or normal capacity, whichever is higher, whichever is higher. So this is for you. This is a gift from my side. In case of fixed overhead, take higher of the two, actual or normal. Actual or normal. Now one student is asking what is absorption? Oh my God, absorption means to include it in inventory, to include it in cost of sale. Okay. For variable overhead, always actual. For fixed overhead, actual or normal, whichever is higher. Let us take one example of case number 3. Okay. So let us come to case number 3, which is The last column in your notes. Case number 3. Case 3, start. Normal capacity right here in the third column, last column, 2 lakh. Normal capacity right 2 lakh. Then you write down fixed overhead 8 lakh. Fixed overhead 8 lakh. Then write down actual production. Actual production write down. Actual production write down 2,50,000. Actual is more than normal. So this time my allocation will be based on actual. So allocation per unit will be 8 lakh divided by 2,50,000. 8 lakh divided by 2,50,000, which is 3.20. Actual sale, write down 2,25,000. Actual inventory will be 2,50,000 produced minus 2,25,000 sold, that is equal to 25,000. Let us talk about how much fixed overhead will be included in the cost of sale. How much fixed overhead will be included in the cost of sale? So I will take 3,20,000, 3.20 into 2,25,000. 3.20 into 2,25,000. This will be included in cost of sale. And how much will be included in closing stock? So I will take 25,000 and I'll multiply by 3.2. That will give me fixed overhead to be included in closing inventory. That comes to 80,000. That comes to 80,000. So if you take the total of these two, it is 8 lakh. And actual is also 8 lakh. Actual is also 8 lakh. If actual is 8 lakh overhead and overhead included in cost of sale and inventory is also 8 lakh, there is no period cost, there is no under absorption, there is no over absorption. All overheads will get absorbed either in cost of sale or in closing stock. So this we have discussed one very important thing about the treatment of fixed overhead, and your exam questions revolve around this treatment. Okay. Today I am going to ask you to write one question for conceptual clarity, one more question, and write one homework today. There is a question number 1 printed below. Below this example, same type of question is printed. So kindly do it as homework. Question number 1, do it as homework. And one question I am going to dictate now, which is very to the power 2 important, very, very important. Right. Following is relevant information for an entity. Following is relevant information for an entity. Full capacity is, everybody will write down the question. You will not find it in your book. Full capacity is 10,000 labor hours in a year. Full capacity is 10,000 labor hours. Capacity can be in unit, capacity can be in terms of labor hours, machine hours. Normal capacity is 7,500 labor hours in a year. So what is important is normal. What is not important? is full capacity. That is given to confuse you. And if you got confused, institute's purpose is served. This question is likely for exam also. Third line, write down actual labor hours. Actual labor hours for current period are, actual labor hours for current period are 6,500 hours. Everybody note down, very important question you will not find in ICI material. Total fixed production overhead is rupees 1,500. So this is fixed production overhead. For fixed production overhead, I will take normal because normal is higher than actual. And the variable production overhead is 2,600. For variable, we will always take actual. For variable, we will always take actual. But for fixed, we will take normal because normal is higher. Because normal is higher. Then write down total opening inventory. Total opening inventory is 2,500 units. Total opening inventory is 2,500 units. Total unit produced in a year. Total unit produced in a year 6500. This is opening plus this is produced. Total units sold in a year. Total units sold in a year. So opening plus production minus sale, you can calculate closing stock yourself later. Opening stock plus production minus sale will give you closing stock. Now write down the cost of inventory is assigned by using FIFO cost formula. FIFO means first in, first out. So first this opening stock will be sold. Okay, total sale is 6700. First I will sell out of opening stock and then I will sell remaining out of current year. Out of current year production. Then I will sell out of current year production. So what remains with me? 2500 plus 6500 minus 6700. So how much you are getting? Just try. You will have in your closing stock 2300 units. Correct? And all these units have come from current year production only. All these units have come from current year production only. Up to this you have noted? Say yes. Write down below. How overhead cost are to be allocated, how overhead costs are to be allocated to cost of goods sold and closing inventory. How overhead costs are to be allocated to the cost of goods sold and closing inventory. So first the student will try. These are my overheads. It has to be apportioned to cost of sale and closing stock. This has to be apportioned over cost of sale and closing stock. So please try. Like I have done that previous question, you will try this question. Please try. Show your intelligence. Let the world know that you are intelligent. How much fixed overhead will be allocated to cost of sale and closing stock? How much variable production overhead will be allocated to cost of sale and closing stock? Very easy question. So many of you, please try. Please try. Okay, have you done? Please give me the answer. If you have done, please give me the answer. Okay, let us solve it together. Let us solve it together. Write down. Please write down the answer. Full capacity is 10,000 hours. That is of no use actually. Even if you don't write, it's okay. Normal capacity is 7,500 hours. Actual capacity is 6,500 hours. Variable overhead 2,600. People have started answering, we will check. I don't remember the answer. Then fixed overhead is given 1,500. This data is already there in the question. Opening stock is given 2,500. Opening stock is 2,500. Production is 6,500 unit. Production is 6,500 unit. And unit sold is 6,700. Unit sold is 6,700. This is given in the question. Now your calculation begins here. So first you calculate closing stock. First you calculate closing stock, opening stock plus production minus minus goods sold 2,500 plus 6,500 minus 6,700, and that closing stock comes to 2,300 unit. Now apply AS-2. What you have learned today? You have learned that variable overhead will be based on actual actual capacity. So therefore you will take 2,600 and divide by 6,500. So that gives you 0.40, and fixed overhead per unit will be, you will take 1,500, this 1,500 fixed overhead, and divide by normal capacity, because normal is higher. So you are getting 0.20. You are getting 0.20. Now according to these calculations, now you will allocate it over cost of goods sold and closing stock. Right? So check your answer. Many of you have given the answer. Step 2, write down. This was step 1. Step 2, write down allocation of overheads. Write in the notebook neatly, cleanly, allocation of overhead. This chapter is also like any other chapter, it requires lot of calculations. So allocation of overhead will be now, first write down under that A, allocation of variable overhead. Allocation of variable overhead. Under that we have 2 points. We have over cost of goods sold. Over cost of goods sold. The total production in this year is 6,500. 2,300 units are in the closing stock. Therefore, current year production which is sold, sale out of current year production will be 6500 minus 2300 and multiplied by variable rate per unit 0.40. So that comes to 1680. That comes to 1680. And now you try closing over closing stock. 2300 units are in closing stock into rate per unit 0.40, that comes to 920. If you take the total 2600, so variable overhead is fully allocated. Variable overhead gets fully allocated. Come to fixed overhead. Allocation of fixed overhead. Under that, over cost of goods sold. Over cost of goods sold. So I will take same 4200 unit. This calculation remains same. 6500 is total production, 2300 is closing stock. So current year production which has been sold, sale out of current year production is 4200 unit and the rate we have calculated is 0.20. So that comes to 840. And then you will say over closing stock, 2300 unit is in the closing stock, 2300 units are in closing stock into 0.20, that is 460. So total is not matching, which means there is some under absorption or idle capacity. Idle capacity will be charged to P&L account. Total production is 6500, whereas the normal capacity was 7500. So during this year there was an idle capacity, unutilized capacity was 1000 unit. 1000 into 0.20, 1000 into 0.20, 200. Now if you take the total, it will match with your fixed overhead. It will match with your fixed overhead. Okay? Answer is not over, just wait. So first you check these two things are matching. Given in the question, total variable overhead and total fixed overhead. Now I'll make a small summary. Summary of absorption. Summary of absorption of overhead. Summary of absorption of overhead. Tomorrow I will dictate one full length problem which will have all adjustment. Okay, in the next lecture. So first you write down overhead absorbed in closing stock 920 variable, 460 fixed. So 1380 gets absorbed over closing stock. Many students had given this answer right. Then unabsorbed overhead 200 we have calculated. 200 we have calculated. Cost of sale variable 1680, fixed date 40, 2520. 2520. No student has given this answer correct. 2520. Nobody has given correctly. Cost of sale will absorb 2520 and total 4100. So this is the breakup of that 4100. 1380 gets included in stock. 200 remains unabsorbed. This will go to P&L account. And cost of sale will be 2520. Cost of sale will be 2520. Okay. So this answer is over. This answer is over. Any query? No query. We'll continue tomorrow at the same time. Okay? Thank you. All the best. Enjoy your day.